Hi, everyone. Alexander, how are you? Pretty good week. Good week, in fact. Hi, Hugo. Hello, Ryan. So let's take a look around just quickly, and I'm going to bring Blake in. Blake has a special guest and talk about the markets here. So interesting that gold failed from this level, from this confluence up here at 1830. Um, I had covered yen shorts, and it's kind of a little bit of a double bottom or maybe a C wave up here. Uh, I'm not doing anything on Fridays. Don't try and make your week on a Friday. It's a kind of a book squaring day instead, unless you have NFP. Okay. And start planning ahead for next week. And TGIF, do you guys know what it stands for? Thank God I found Forex Analytics. If you feel that way, give me a Y. Okay. Okay. Hi, Thomas. Malia, Thomas. Okay. So we're in agreement on something. All right. So we have to thank the partners that started this up a little over 4 years ago. And I think we've helped quite a few traders over the years. And I'm going to turn it over to our CEO, Blake. And Blake will introduce his special guest today. TGIF, Blake, thank God I found Forex Analytics.
I love
Thank,
that. I love that saying. That's great.
yeah, thank
How you doing,
God
Dale?
you developed, and Steven Stelius developed Forex Analytics.
Well, I appreciate that, and the first person we called, it was you. So, you were our first person
Draft
on board.
choice. I was the number one draft choice for Forex
You were the
Analytics.
number one draft choice at the time. So
Yeah,
it's been, a pleasure to
I
be.
did get a signing bonus too. I got
Yeah.
an iPad.
Did you? Oh, I did you?
Yeah, you
I don't
sent me an
remember.
iPad. So,
Oh.
it was, I felt like I was in the NFL or NBA.
Oh yeah, that's right. I remember. I remember that now. Yeah, that's right.
Yeah,
I forgot what we did. We did get you that. It was for a specific reason. I can't remember, but anyway.
yeah.
But it's been a heck of a journey. We've I think it's interesting. I was talking to you. Do you remember from the Traders Summit event that we had last fall? I was talking to Stephen Goldstein.
Yeah, yeah,
Yeah, I was
yeah.
talking to him yesterday, just kind of about like my journey the last 5 years. And we were just talking, and he's like, I'm going to have you on my podcast. So he's going to put me on his podcast like sometime in August or September. But we're going to be doing
Cool.
some interviews with him, just because he's great. He knew Mark Douglas, and I knew Mark Douglas back before he passed away. And anyway, the point being
He
that.
helped Jack find a couple of the unknown wizards.
Oh, did he really? That's
Yep, Jack
awesome.
Schwager's that. Yeah, Jack
That's
and
pretty.
him know
That's
each
pretty
other.
cool.
Yeah,
He's a neat guy, interesting guy, and but I guess we were just talking about, kind of my journey to where we've been, and or where we've been as a company, and we talked about how we're really a lot in the same business, just trying to help the trader, and that's what we do here at Forex Analytics. We just we attempt to help the average trader get ahead, and
yeah.
reshape the bell curve, if you will. And so I've been really fortunate to be able to share this all with you and share this journey with you guys. So anyway, without getting too far into that, let's talk about where the markets are at right now, and kind of what we're looking at as far as the dollar goes. And the one thing that I have to say, Dale, the dollar is really nudged up against very critical resistance at this point. We've been looking at this big triangle, And notice how the dollar is just wedging into the triangle here. I mean, when
Yeah.
you're nudging up against resistance and not backing away,
Yeah.
it's, that's something that we have to, keep in mind. Now, today we do have retail sales data that's coming out. But I do feel that because the current state of where the market's at, what do you think is going to be the most important data today? It's going to be the inflation data, right? We have
Oh, we have
University of
more of that?
Michigan. We have
Oh, okay.
University of Michigan inflation expectations later
Okay.
today. And so if that survey, which is only a small survey, but if people are starting to feel that inflation is an issue, and you see those inflation expectations move higher, that's going to worry the market a little bit, that the Fed might be behind the curve and tapering might be something that is on the table a little sooner rather than later. You've got a lot of other central banks that are already starting the taper process. So if the Fed doesn't want to get behind the curve here, and then you're going to start seeing the dollar really spike up. So I would be fearful, guys, that the dollar might make a move for this breakout area around 93. If the dollar clears 93 today, which is only 30 cents away for the dollar index, we could see a pretty big move. But I don't want to talk too much about the FX market just myself. I want to bring in our guest today, and I know you have an interview today, but
Right.
we also have Ryan Littlestone from Forex Flow Live that we thought we'd bring him in here really quick and let him give a view of our market and of the market. And the cool thing about Ryan is we've developed a bit of a relationship over the last several months. And I did an interview with him. I want to say it was about 2 months ago, and I need to do more interviews with him because he's a really knowledgeable guy. And I want to start by saying that I've known Ryan since he was with Adam Button at Forex Live. And, Forex Live was taken over from Jamie Coleman. I want to say, gosh, it must have been, I don't know if, Ryan can help me out with the timeline. It would probably be about, 5 or 6 years ago. And then Ryan was, a constant voice on Forex Live. And he broke off to do his own thing at Forex Flow. And it's interesting. I figured out about 2 years ago how to set up Twitter. And even though I've been using Twitter for like 12 years, I finally figured out how to actually use the set notification on my phone and my mobile devices. And so I get notified from 3 accounts on Twitter. And I'm sorry to say, Dale, you're not one of them.
It's okay.
Nor is Steve. I'm just, but you know who's one of them? Is Ryan and Forex Flow Live. And that should be a testament of how knowledgeable he is in the markets. When, I look towards like 3 people to get 3 specific Twitter handles to actually get data as news is breaking. I know somebody's going to be on it. That's Ryan. So I'm really, really pleased to have Ryan join us today. Ryan, good morning. How are you? Can you hear us today? Let's see. Let me see if he's here.
He's muted. He's there. Oh, there he goes.
Oh, there he is.
I'm here.
Hey,
right?
you found the unmute button. Good morning, Ryan.
Yeah. Morning, all. I don't know if I'm going to get my head through the door after that big up there, Blake. Thank you very much.
And it's really true, Ryan. I'm not joking. And this has really been. I'll tell you when I figured this all out. It was during the Trump presidency era. I mean, obviously, the markets seem to be they would spike in certain directions at random times of the day. And I wanted to be notified, like, okay, if the market was moving, there was a few people that I knew that would be on top of the news as it was breaking. So if I wasn't at my desk and I had my phone in my hand and I was driving or, with the kids or whatever I was doing, I knew that there was three Twitter handles I could always rely on. And you happen to be one of them, because the way you break down breaking news, your thought process, understanding exactly how the market's reacting to what just hit the market, it's really unparalleled to anybody else. And so that truly is a testament to what you do and how you approach the market. So thank you very much for what you do for all the currency traders out there.
No, thank you very much, Blake. And the feeling's mutual. I've spoken to Dale often in the past, you guys as well. Great bunch of people over there. It's good to have this group. You get to know who the decent people are in this market. There's a lot of sharks in this market, and over the years you get to know who knows what they're talking about, who you can rely on, and that's important for traders because there's a hell of a lot of commentary out there, and getting the right people, because I use it as well. You own your business there at Forex Analytics, I own mine here, but we still traders and we still want to hear from others. So it's just as important to us being these business owners as it is for us being traders like everyone else.
100% agree. So it's, and like I said, it's a pleasure having you here, and I really feel that our traders, not only just our community, but all the traders out there that trade the currency market, really need to have their staples of the people that they can trust and who they can listen to. And I really truly feel that you're one of those people in the FX market, in the FX business. You've really done great with Forex Flow Live, and so we're excited to have you here today. So what I'd like to actually get your input today is on how are you viewing this like spike higher in inflation? It seems persistently high. We've had, the Fed chairman this week talk about how the numbers were a little bit even beyond what he had expected, not using his terms exactly. But I think that's been one of the things that's kept the dollar really well bid, even in a risk on environment. And that's been one of the confusing things for a lot of people is, you got the NASDAQ and you got the S&P and you got the Dow, at or near all-time highs, and we keep, breaking highs. And then here you go, you got the dollar that's just running really firm. So how are you breaking down what happened this week with Powell's comments and the price action we've seen in currencies? What are you thinking right now?
Right, just to give a quick read back over it all. I saw this coming, and a lot of our guys in my room saw this coming mid of last year, for a couple of reasons. We saw inflation coming, one, because of a natural snapback in the recovery. But two, one of the overwhelming feelings was that central banks were just knocking the fact that inflation could come. It was as if there's never going to be inflation ever again. And you know what happens when people say things like that? It's going to bite them in the arse. And to be honest, I wrote a piece last year because I went long dollar yen September last year on the very back of inflation that was going to start jumping, building up a position. And, one of the things I wrote is, what are they going to do if their low inflation suddenly hits 3, 4, 5%? And lo and behold, here we are. And I didn't expect it to get that high myself. But what we've seen is, I think we've had a lot of the inflation expectations already come in through the early part of the year as economies reopened, virus, vaccines, all that sort of stuff. And, we saw the move in bond yields, 10s rocketing right up. But now that's all moderated. So the market may have run too high on the inflation expectations. Now they come back a bit. But the Fed is still insistent it's transitory. And so at the moment, we're in a situation where the market's saying, hey, look, we got inflation here at 5.4% or whatever. And you got Powell saying, yeah, but it's transitory. There's a fight going on there. bond markets are a bit like, well, is it, isn't it, is it, isn't it? 1 minute we're at 140, next minute we're at 130 in yields in, US 10s. But then this week, Powell, I think, has made a pretty stern message where he's kicked the can right into the jobs market, because we've been talking about inflation, and we've got to remember that the Fed has two mandates, full employment, or maximum employment as they call it, and stable prices. Well, they've got hot inflation, but the jobs market is still lacking a bit. And he made that point pretty clear in his opening testimony. And the 2 days we had, the jobs market is of importance as well. And so the market's now going to be focusing on that. But again, even in that, we've got a big disparity. You've got JOLTS coming out showing that there's over 9 million vacancies, and you've got Fed members saying that the jobs market is still 7.5 million people short. Well, that doesn't compute. You've got all those vacancies and all those people who lost their jobs. Why aren't we seeing them? Why aren't we seeing that gap close?
Yeah.
Possibly we think that it's because of the job benefits that are in America. They're slowly coming out. When they finally drop off, I think it's into September, that's when we're going to see a big change in the jobs market. We're going to see, are people really going to get back to work, or are there issues? And that's going to define the central banks into the latter part of the year.
Yeah, and I actually agree with you. And there's a state by state, and it's going to be different throughout the United States. We're some of the benefits are going to taper off here in the next whatever it is, 12 days or however many days we have in July. Actually, it's going to be in about 2 weeks. But as that tapers off, are you going to see that gap close?
That's exactly the thing. It's a big gap. It's a huge gap. And we politely call it the sofa squad. The people who are potentially sitting on wage benefits and not going to work because they don't need to. They're happy to take the checks, and until they stop, then maybe we see something. But that's going to be a crunch point, because if those jobs don't go back into the market, if those workers don't go back into the market, you're potentially going to have a slowdown in activity. Then, the big fear I've got for next year is stagflation. That's my number one risk next year, that we don't see the economies, continue to recover, or they tail off, but we see this persistent high inflation. And that's going to be, I don't even want to start thinking about it. Let's get through this year.
That's really a toxic mix for any economy, let alone the global economy. I mean, and I've heard actually a few people really talk about this seriously. I know we've discussed the risks of stagflation earlier this year, but it's kind of like, it's very taboo. Let's not even talk about that. But this could be a real issue where you have slower growth and you have persistently high inflation, and that is a very toxic mix for an economy. And we could really see it here in the US, and I think a lot of people are looking at, these prices. They're like, used car prices, they've increased, 20, 30, 40% in some cases. Like,
never thought a used car would be a good investment.
Oh, my son.
I mean, any car, unless it was a classic.
Yeah.
There are many.
No, I'll give you an example. My 16-year-old son, he has a Honda Civic. It's an older Honda Civic, and it's gone up $2,000 in value. From $5,000 to $7,000. He's like, Dad, should I sell it and lock in a couple thousand?
Anything that has intrinsic value has the property of maintaining its purchasing power during inflation, right?
Yeah, I mean,
but used car prices did not go up, Steve, in the late 70s when we had really the last inflation thing. You didn't have that.
And Steve, you got to take it from Dale, who happened to be there, and
but I don't know if I trust him, because Dale was too old back then.
No,
so he might not remember.
Come on, man. It was
all right.
Sex, drugs, rock and roll, man.
He was in his 70s back then.
Hey. By the way, let's remember Ryan's still here. We're still having a discussion with Ryan. So, Ryan, sorry about that. Excuse the partners there.
Yeah, I told you about the black sheep. Ryan.
Yeah, you did.
All right.
But
So-
it's a fair point, because the used car thing is a fair point, and you can stick that in the transitory inflation column, because the reason used cars are up is because there's fields and fields of new cars sitting there without electronics and semiconductors because of shortages.
Yeah.
So yeah, you've got this short-term market in used cars, which eventually will drop off if all those shortages fall out. But one of your guys here, Ziggy Siggy, has said, good point. The child tax credit has just kicked in this week, and I think that's like $300 a month, maybe higher for under sixes or something. And that's kicking in a month until December. Again, people are getting paid to sit at home, and that's not good. That's not good. And we're the same here in the UK. We've got the furlough scheme, which ends in September. And I'm marking the calendar to see how's the October jobs report going to be. Are we going to see a big influx of people back into the market or not? Or are we going to see a high employment where firms have just been sort of, on life support with a furlough, and now they can't continue, and now they're going to just sack people, and that's it. So, lots in the mix.
Yeah. So, okay, let's turn our attention then, with everything, just keeping in mind everything that you've been talking about, and especially inflation related. And you look at the equity markets, and I've got the S&P up here, but you could really, you can look at other markets, whether you're in the UK, whether you're in, you're looking at the German DAX, whatever markets you're looking at, they are elevated. Is this a product of, easy money meets, inflationary prices? So of course, as we're seeing higher inflation globally, stocks are going to perform better in a higher inflation environment, or, how do you interpret that, Ryan? And what are your thoughts here? I mean, it's easy to say, well, the markets are overbought and they're going to correct, but I've been saying that for a very long time, and we haven't seen the markets back off at all. So, how do you interpret all that?
I think it's going to come down to several factors. Obviously, we've got QE pumping prices. We know that that's been going on for nearly a decade now. It's not new news. So you expect to get some sort of correction there, or easing there in stock prices when QE starts getting tapered. I don't think we're going to get the so-called taper tantrums that we got last time. This isn't new now. The last time it was new, QE was new, tapering was new. This isn't new. We've been here before. We know it's going to happen. The market knows what's going to happen. I don't think we're going to get the tantrum that we got last time. But secondly, what's propping up markets? Again, you look at the Sofa Squad, and we hear all the Robin Hooders. Are they putting in their stim checks into stock markets? Is that going on? Again, that might switch as people go back to work, or people suddenly need finances and all get out of stocks. We can't underestimate the retail market these days. The tide has shifted between institution and retail hugely over the last few years. Retail had become a bigger monster, and they can drive prices now. So what will happen is, I think, we get through QE getting turned off and that sort of stuff, and maybe into the first rate hikes. But from that point, then we get to see what the economy is really going to do. Is there activity there? And that's then going to be the driver of stocks. And if all is good, then you're going to be buying the dip again. And if things are going to wobble, then perhaps we get stock markets acting normally and going up and down on the fundamentals and the economics. But you're talking maybe 3-6 months down the line before we get into that.
Well, that turns us back to our attention towards the FX market and volatility. And I've said this for the last, people remember from years ago, 5-6 years ago. Hey, but I've always said that unfortunately, every central bank is going to go to a ZIRP or NIRP policy. Eventually, and we basically got that for the most part. Most central banks basically went to as close to zero bound as they could get. And but the good news is, with inflation expectations rising, with that's going to bring interest rate expectations moving, starting to move. You're starting to hear taper talk, and inflation, and inflation persistently high, stagflation, whatever the case may be. you know, it is going to change expectations from banks and traders on what central banks are going to be doing with monetary policy, which is going to bring us hopefully higher volatility in the FX market. And that's what all of us in the currency market has been really hoping for over, you know, especially in recent in recent years. You know, we've seen this persistently low volatility in the FX market. So do you think that volatility is coming back in currencies? I do. I'd love to hear your take, Ryan.
Yeah, I think it is. I mean, I think you know, what we've suffered from is, you know, before the virus hit and everything, we were still coming off of the GFC and all that sort of stuff, and you know, volatility was right down. You know, as is natural when you come off, you know, big fundamental events like that.
Yeah.
And it's weird that the world these days is much faster. I mean, if you take the virus hit within the space of a month. Was it March, April? We had the crash. We had the blowout in markets. 2 weeks it lasted.
Isn't that unbelievable? Like,
you know, and you think to yourself, what's happened there? You know, 2 weeks, and things just happen much quicker. So what we find now is that when things are calm, when things are quiet, bang, volatility just drops through the floor, and you're sitting here picking your nose and watching dollar yen in a 5-pip range for 2 hours, and then it's interspersed with news and events and whatever. But I think, as you say, I think volatility is starting to creep back in. The latter part of this year is going to be very big for volatility, probably into Q1, Q2 next year as well. And you know, this is trading. You take the rough with the smooth, and you know, we've all felt it. We've all sat here, and, as I say, watch prices move 10 ticks in an hour. That's part and parcel, but we've got to be ready for when the vol does kick in, and I think that's coming.
yeah, I agree with you, Ryan, and like you, and I know myself and everybody that's listening in here, we are really ready for higher volatility. And just to cue you guys all in, this is the S&P. This is an ascending wedge. It's my favorite reversal pattern of all time. It is a setup. It doesn't mean, you know, you start shorting stocks right now, but it's something that, you know, hey, we start getting below, you know, 4,200, 4,250, somewhere there in the S&P, probably somewhere in this neighborhood right here. Then we start looking at, you know, the stock market pulling back a little bit, and that means higher volatility in FX. Ryan, I want to thank you so much for being here today. It's a real pleasure. I know Dale's got an interview, but I'm just so glad that you could be here, because like I mentioned to everybody listening in before, or listening in earlier, and this is something that you said specifically, you know, you in this industry, there's a lot of people in this industry, and there's a lot of sharks. There's a lot of people that don't really know what they're doing. You are somebody I've gained a lot of respect for when you were with Forex Live, especially when you broke out on your own. I've watched you really blossom with Forex Flow Live. I have alerts on my personal phone when you tweet, which is a testament, you know, for anybody who's been listening to me for a long period of time, know that I don't do that with a lot of people. I've been trading for nearly 25 years now, and I know there's certain people like yourself that I just trust, and I trust your analysis. I trust your instincts in the market. So thank you so much for being a part of our community, and you know, really helping the individual traders around the world. So
yeah, thank you very much, Blake. And just maybe time that I'd just like to drop in that people need to watch this space, because there's a big announcement coming over the next couple of days. So if you're following Forex Analytics, and if you're following myself, Forex Flow, on the socials and whatever, keep your ears tuned for a big announcement coming.
yeah, and yeah, I know a lot of people have been you know, kind of hanging around, trying to. We've been teasing everybody for a big announcement over the last week or two, and then I bolted out of town, and we were going to try to handle it beforehand. We're trying to just tighten up some things. Next week, guys, be around on Tuesday. Make sure you're listening in on the Face webinar next Tuesday. we'll have a big announcement for all of you. But Dale, I want to turn it over to you, and I want to thank you, Ryan, again for being here today. Steve Stelios,
By-
we didn't.
By the way,
Thanks, guys.
big beat core retail sales in US. Big beat.
Oh, big beat.
Yeah.
US retail sales. Well, let's see if those inflation expectations are going to be big, because that's going to be the number to watch today. So thank you, Stelios. Steve, sorry we didn't get a chance to talk a whole lot today.
No problem.
But we will, guys and gals, just remember, if you're a Forex Analytics subscriber, you will be seeing us on the Morning Edge webinar in 45 minutes. We will be talking about, well, we'll be breaking down the markets and finding all of the, key support and resistance levels with you. So I'll see you guys in 45 minutes on the Morning Edge, as we do every day. Ryan, thanks again. Steve Stelios, I'll see you guys in 45 minutes. Dale, you're the bomb, and have a great interview.
Have a great weekend, Blake, team.
Thanks,
And-
guys.
And Ryan, have a great weekend. And Francis Hunt, welcome to Face. Looking forward to having a conversation with you. Been following you on Twitter for quite some time. Even Blake said he's been following you for years. So waiting to hear your voice.
Hey,
How you doing?
how are you guys?
Hey,
thank you very
Sni-
much for having me on. Delighted to be here.
Oh, it's great to have you, Sniper.
Thank you.
All
Glad to be
right.
with
So if you want to share your screen, you can do that. Have you been on Zoom before? I'm sure everyone's used Zoom.
Yeah.
And if you want to be on camera and let people see you, that too.
I tend to do that. Yeah.
Okay.
That's okay.
Yeah, I
As
didn't
long as they
shave.
don't criticize my fashion sense, I'll survive it,
All
I
right.
think.
I didn't shave, but that's okay. Right? It's Friday, we're traders. So, Francis, really great to meet you. And,
Thank you.
yeah, I've been to your website, and I don't know, many years ago, I may have been sending the emails when I was looking for a gig. I don't know. I mean, I think I hit up everybody. So, what I'd like to do before we get to the markets real quickly, Francis, is why don't you tell us about your genesis as a trader or entree into the industry, into the trading industry? How did it start for you?
Oh, absolute pleasure. Yes, I'll try to keep it brief. It was love at first bite, Dale.
good
Like you, although not quite to the extent as you, I think you've always got to respect old warriors in a career where the men die young. But like you, I started early. My parents were in Africa. My father was an Englishman, my mother a Frenchman, and they had various bequests come their way when their parents passed on, and they invested into mutual funds during the equity bull market of the 80s.
Okay. Yeah.
And I had an aunt who never married, and I was one of many nieces and nephews, and I was very lucky. I got a couple of £1,000, which was a lot of money in those days, and it was 1987. And I'd listened to my parents doing, essentially checking the newspapers, because that's what you did for prices
Right.
back then, on the likes of Old Mutual and Guard Bank, which were big prominent mutual funds in South Africa at the time. And, my father was driving from one big city to another, about 45, 60 Ks, and they were every day to work. And I was seeing that they were reporting making almost more money with this bull market than they were earning. And I always liked that idea. It was love at first bite in terms of working smart over hard. So I'm driven by laziness, in essence, quality of decisions that can make you put you in the right direction. And of course, I put all my bequest into the market. I was drafted into the army. It was compulsory at the time in August of 1987. So I put 100% of everything into the mutual fund market to catch the crash of 1987, which I'm sure as a historian, you'll have your own experience of that, and it'll be one you'll remember well. So I got a 40% plus haircut literally within weeks of everything I owned, which was basically close to 100% of my net worth at that time. So that's why I say love at first bite, because it bit hard.
Through the fire right away. A veteran pulled me aside, Francis, when I was getting my seat at the CME, and he said, "Kid, this is a tough way to make an easy buck. And he was definitely right. So, and it's a good memory because I was a kid then. So, yeah, one time I too was a kid. So, thanks for that, Francis. You know, it was one of our attendees that made the request that I bring you on, and I know you have markets here, but her desire was to hear your narrative on the Great Reset. And I'm sure some of the markets that you're going to be showing us are part of it. But you know, I'd be interested in what your concept is of the Great Reset. A lot of people talk about it, but a lot of people have different scenarios for the Great Reset. What are you looking for?
Wow, that's such a broad and great question. It's an outstanding one, and it encompasses everything. So if I was the trader animal, I would be the thermaling eagle. We all think we're eagles. Nobody ever is a warthog or an earthworm. We're all eagles and lions. But I would certainly be...
I say don't be a pigeon.
Exactly.
All right. And also, by the way, your video box, I'm not seeing your image. I see the square.
Yeah, it's telling me it's blocked. You cannot start your video because the host has
Steve,
stopped
are
it.
you there? Can you unblock Francis's video,
Yes,
please? If
already
you're still
done.
there? Oh, you've done it? So, okay, try it again, Francis.
Yeah, let's do that. There we go. Now,
okay, now you're with me. Okay,
that's it. Let's get.
Thank you, Steve.
No problem. Yeah. So yeah. So the grand macro. So I'm cursed with too many economies, and trading fascinate me intrinsically. So I'm a grand macro technical analyst, my specialist skill. So I like looking at big time frame charts, particularly. And I've also specialized in creating a particular methodology that sets an immense amount of cones that have to be lined up before you put on a trade. In other words, my worldview and experience is people have too frivolous a number of reasons for putting on a trade. You need to trade less to make more.
Yes.
So less being more, and you need a multitude more reasons. This implies patience. It's not only patience isn't just sitting around, it's what you do while you're sitting around. You've got to learn, line up and analyze. So I do, my hours of charting per trade is substantially higher than anybody else's. That I know, on the basis that we look 360-degree analysis, we look at antagonist markets, correlated markets, we see how it fits into this grand macro. So I have a kind of war room in my head of where I think the world is going, because that has steered me in a number of very accurate directions. By the way, I get a lot wrong, but I'm just going to steer you to what might sound like a flattering statement. So I want to absolutely confirm that I get as much wrong as I get right as any of the other guys. But the grand macro view saw us be very bearish oil in the 60s, and it was supported by our grand macro technical. And 360-degree analysis saw us also feel similarly short about oil companies as we mine the seam. Think of it almost as that horrific activity of fracking, which is so unfriendly. Not only do we go down, we go horizontally along, and we frack the market in terms of our analysis. So we were looking at Tullow oil. I was looking at Plains All American Pipeline, all around the commodity trade idea, long before any trades were put on. And we kept finding technically that we felt equally bearish, all of them. The story I mentioned is that we had a similar feeling with Carnival, the cruise liner, which was bizarre because it has oil as an input. And if we're bearish oil as the commodity, why would a cruise liner, which apart from staffing probably has its second biggest cost in burning grease to keep floating. And as a result, we got the answer in the form of the pandemic. So I have truly trust the footprints in the sand, the charts before news. Most people say, I don't trade news, but they're always still thinking fundamentally when they should. Absolutely. I call it almost ignorance is bliss fundamentally. You almost want to have a news block out and look for themes the difficult way backwards. And there's some great authors in the stateside. I'm showing up on your morning. I'm not in America at the moment, but Stephen Covey, you'll know, he said, begin with the end in mind and work back. So I go say, what is the technically of interest to me on a big time frame? Because I'm not a day trader. I think you should do less and do more analysis. And I pick up the grand stories. And I picked up a short interest in oil. We'd previously caught it in July 14. Should probably bring up the US.
So this is recent, the recent WTI top that we had a failing rally this week, that you're negative oil again.
No, sir. Let me.
That was back a year and a half.
I'm giving you history now. Yes, indeed. I'm giving you history that led into. I would not characterize. In fact, we've flipped now, and I will bring you up to date as part of the process of this. I'm just going to remove the log scale because oil spiked to zero. It spoils the chart. So if I'm just showing you this is a macro falling wedge. And if I were to surmise how your question was, and I must answer the question is, or give you at least a feel for how you answer such a broad question, is that by being grand macro, I essentially, and I like you, I love to teach and illustrate. I'm going to just grab a pen here and I'll just highlight. Essentially, I grew up in this era of relatively stable oil prices. You say relatively stable, the low end is 10 to 15 and the high end was sort of 30 to 35. Round about the Greenspan era in my worldview, we started to leak to the upside. Greenspan came in 87. We started to become more upward bias. We went totally liquidity orientated in the .com. So after the .com bust, particularly in the States, you went into a recession. The UK managed to miss, which is where I was at the time. But there was a big fear of deflation because there was such a loss of valuation. Remember, even Amazon fell from over $100 to around 6 or 7, and the rest died entirely. So there was a lot of liquidity provided. That's where you get that rising wedge that I've drawn, and you broke out of this range that was our medium. I tend to put a splitter, that's the orange line, in everything I do. So I like to determine ranges. That then, if we're talking about oil, which I know is a market you like, you cover FX and the big indices. So we're keeping it here so it's relevant, hopefully, for the bulk of your audience. This turned into the big bull period for oil as a result of excess liquidity in the macroeconomic system. So I don't want to ever offend anyone. This is just my take. Don't get provoked. But I treat, so some people might think that's a bit conspiratorial and you're a weirdo or a tinfoil hat wearer. To me, oil is the first global tax. I call it the Rockefeller tax, because when we got the property boom, one of the things that taxed everybody, no matter which country you're in, was the increase in oil price. So whether you think that there's still monopolies or big interests, I won't go there. That's a different, more reset-y type discussion. This was a huge bull surge.
Right. Parabolic.
That came. And actually, you went up to around 145. This entire falling wedge is our corrective. So I've seen that you also have some good eliticians. You've got some amazing guys, by the way, in your community. I was checking out your site. Really cool. This would be kind of, for the eliticians, this would be your first corrective leg in this entire falling wedge. And we were engaged in calling a short there. And we were lucky because we were initially wrong. So again, I want to always say, we get just as much wrong as the next guy, but we flipped at the key moment. So we had what we call a squeeze. So our methodology is very, very focused on a very tight volatility-based event. This, and you've totally got this because I was listening to a lot of your material, is you don't just take someone traded before a non-farm and you said, yes, you got lucky because it went Euro USD on a binary event. It's absolutely correct. What you really want to do if you're going to take a risk on direction is you want to have an asymmetric potential upside for a very clearly defined limited risk to the downside. So even if it turns out a 50-50 or even a 60-40 against, if you're getting 5 R's to the upside and sacrificing only 1 to the downside, the long run, those opportunities pay you net. and you eat your losses as it's just the next one until I get one of the 5s on the correct side. So we were expecting upside continuation because our default is continuation. So I'm quite Newtonian in that sense. Things keep moving until an equal and opposite force starts to act on them and overcomes the initial force. So our default position is continuation. Too many folks, I think, try to trade reversals. Small sidebar for those that do use indicators like RSI and other things. It does have a tendency, if you're not adjusting for that, to encourage top calling and bottom picking. Because an RSI going from one end to another end, you now automatically assume it has to immediately return back down to the other side. An RSI can stay high and even come off a little bit, and you can remain in a bull run. And similarly in a bear scenario. So watch that. We initially were assuming continuation. Then there was the whole Ukraine war heating up, and this thing wasn't moving. And we set our final level and we flipped and we went short there. And we were shocked by the amount that this sold off, because it actually took out the subprime low that I'm highlighting. So we had a target down at 60, and we thought we'd leave a little bit on. We were totally closed out and the market kept falling. And that was almost like a losing trade in some senses. You know, you feel opportunity cost should also be seen sometimes as loss. And I sat back and I thought, why did we get out so early with $60 oil being early? And we realized this was an overperformance event. You went into the China over indebtedness and a bit of a crash, the Shanghai Accord, when China effectively became as indebted as all the other coordinated and synchronized other central bank driven major economies. So you have, whether you're in Australia, London, the US, and now in the East, and of course, Japan was there before everyone else. And this
Francis, I just want to say we have 14 minutes left on the interview. I don't want to spend the majority on history.
No,
I wonder if we could get in the time machine and get to today and where we are today and what your thoughts
are you happy
on
for it to be on oil? Are you looking for an opinion on this, or would you like to transition?
I want to know what your concept is for the Great Reset and how people should prep for it, and what markets they should be paying attention to. And that's the reason I brought you on is Hannah wanted you to talk about the Great Reset. So,
the key markets will be the universal markets like oil. Debt markets, which I'll show you very quickly because we'll skip past each one just on a fly past basis because we won't have time to do deep dives. This is your macro 10-year yield.
Yeah.
I'm just going to hide my annotations, might overwhelm people initially because I have a lot of drawers that I keep on. So this is yield on debt. My hypothesis is that people's appetite for government-based debt is diminished. And that the 40-year bull market in bonds that spanned my older brother's entire bond trader career is probably over, and that the COVID event was the bookmarking end for that. Right now, you are actually getting the yields come back down a little bit on the 10-year, so it might seem incorrect. But when you log scale this percentage-based capitulation, and I've heard you mention this before, it's very typical of ending trend events. It's like a blow off at a top and it's like a final capitulation at a bottom. So I'm sticking my neck out and saying debt market is a turn. This is another key market to be observed. So we're saying oil long run up. You might have a little return move because of that falling wedge, supposedly people believing the Fed will tighten, all of that, little return move, long run up, and even all-time highs beyond those highs. So two big macro calls, two big markets to watch. What other markets to watch? Well, the dollar and of course, precious metals. So with fiat, I'll take you to the Dixie and I'm going to highlight something here as well. I'll just unlock those drawers for you. This is the dollar index. So again, very macro. This of course includes a lot of the euro and then the Swiss and the pound and some of the others. So it's not a perfect match for all other currencies. This is a falling wedge that we've already broken out of. That breakout event was came a lot later. So from a lot earlier, apologies. 2008 was the low, and 2014 you broke out of this wedge and you returned. And we're now in some form of a structure. There's a gentleman who talks about the dollar milkshake theory. His name's Brent Johnson. Go have a chat with him. He may be right. I think he was early which many people will say is wrong, but I think in the long run, a smart guy who's wrong is worth listening to because he may long run be right. So in the realm of fiats, we collapse from the smaller inward is my hypothesis. So the likes of the Rand, the Lira roll over, and then and the others get forced up as that money has to first run into other fiats, with the dollar being the key in the middle. So that's another reset. So we've spoken about dollar, we've spoken about oil, we've shown
Okay,
you
so
yields
a higher
based on-
dollar that we follow through from this breakout. We've had a few retests of that wedge, and do you think we could have another retest here, or the recent lows that we have here, a dollar rally is underway? And the milkshake theory is talking about like a 120 Dixie, isn't it, Francis? People
I'm not
talking
sure
about
what Brent's latest prediction is. Don't quote me, so I'd rather not
Yeah.
say.
that? Okay, but it's way up there.
By the way, it's not going to be your best trade because you're trading one flawed weak currency against an even more flawed, smaller weak currency.
Okay.
So
yeah,
always
got it.
position a beauty queen against the ugliest dog in the pound.
Yeah.
Don't trade slightly less ugly against an ugly puppy. Take your beauty queen. So this is more something to observe as part of the process of potential fiat failure, dollar
Okay.
strengthening. If it goes up too fast, too soon, things get disorderly super quick because
Yeah.
Turkey overly indebted. They're already at 19% interest rates, trying to pretend that we traded the USD lira very, very successfully for the last decade. Nearly always to the long side, apart from after the blow off, we shorted because they put their rates so high. We had such a beautiful carry by just holding the trade open, and then it pulled back quite substantially. So what's your carry costs? A quick note on that. Last year on a single account, I had £180,000 just in trading costs, holding open trades. That was
Wow.
financing all sorts
Yeah.
of things. And that was a huge percentage of the profit for the year. You truly need to recognize it. Admittedly, I had some lira at very high interest there, and it was about 50% of that. But if you took all of that out, and I never traded lira, you would still have £90,000 of open carry cost. Do you do your P&L at the end of your year where you tally how much it's cost you just to be in the game and hold those open positions?
Great point.
Time stops. We kill trades if they aren't doing what we expect they do. You may have a stop and you may have a target, but what if they vacillate somewhere in between and you start to portfolio? Do not portfolio trades. Do not hodl and hold on to trades. You get comfy seeing it in your blotter. It's like an old friend. Every morning you open it up and it's there. No, no, no. The carry cost, you're missing this. You're not reading your statements. Time stops. It must do what you expect it to do in the time. Otherwise, new forces have come in and are countervailing. So, Carl.
Interesting. All right. And with conviction. So I'm thinking, of course, that you're probably looking at gold as not being
Yes,
an
let's take you to
inflation
the shiny
hedge.
stuff. Yeah, let's
Yeah.
take you to the shiny stuff. The
Yeah.
interesting thing, and this has a 360-degree analysis point on it. So I'll bring up the gold futures, which everyone will recognize. And of course, that's against the dollar. However, the best technical setups that came out of this was actually on the euro and the pound. Remember, especially if you're US based, you're so comfortable with everything being benchmarked against your home currency. It's always about that. You forget that there's a footprint and a movement in your own currency. It is not the stake in the ground that is stable and everything else is on a chain walking around it. You've got to look at it versus other currencies. And this is part of our 360-degree value thinking. So actually looking at the pound gold and the euro gold gave us this structural setup that saw us when we called that short on the oil side. We were saying simultaneously, because we were measuring gold's value in oil barrels, and we thought it was ridiculously low, too few oil barrels to buy an ounce of gold. We said, not only should you be shorting the oil into what ended up the coronavirus, which was clearly exceptional events, you should also be long the gold at the same time. And that took off in the beginning of 19 and made its targets as you were going into COVID there in March of 20.
Yeah.
So not only did we nail this, and this is just something that we got right on that occasion. As I say, we get lots wrong, but you by doing the 360 analysis, you could see, great, I will close my dollar-based gold trades when the gold euro and gold pound met their targets. And that's exactly what we did, because we want the liquidity of the gold against the dollar, the tighter spreads, et cetera, et cetera. But that doesn't stop you from doing TAs on a different benchmark. The euro was very the same. I barely changed the drawing. I wiped the face. You can see it's pretty similar, the euro.
Yeah.
And this is a classic macro constriction. Range bound, you have your blow off, you have your pullback, your second impulse, your third, then you rest, and then you go. That was your trade. That's on a log scale. It doesn't look impressive. Let me just refresh you by delogging the scale so that everyone can see. It was a substantial move. But like everything, you must take off. That was the move you caught. And that is when our targets were all met. And within literally days, the gold market actually had a longer than most of us, certainly what I expected, pullback. And it's still not fully done gestating. So the value of leverage is you must have a target and a takeoff point. There's a difference between invest. I invest in silver and gold. I hold it. I don't care on the daily price, the weekly price, the monthly moves generally, because that's a fundamental long-termer. When you're borrowing money and you have carry cost, time matters. You must have a point where you take off. If it doesn't perform, you have a time stop as well as a loss stop. So those are key messages that I would deliver, and that's part of our major message.
All right. Regarding precious metals, you know, we had that tremendous move in the gold silver ratio when you could have turned in 1 ounce of gold for 110 ounces of silver. And that's come in. It's trying to trade above 68. Looks like it's trying to correct. Are you expecting in this great reset for silver to continue to outperform gold, or will people go to the monetary metal ahead of the semi-precious industrial metal?
So how you finish there is how the precious bull markets start. Once they've properly got going, then it pivots to the higher beta silver outperforming, generally in our worldview. And again, with the pandemic example where you had both Bitcoin, you had gold and silver collapse into the pandemic, and you had silver actually trade $11 in that low. That was a final capitulation. So in the same sense that I mentioned, it was a book-ending event. Essentially, you shut down the globe. So gold and silver had their final capitulations in our view, particularly silver, and that's where you got the gold silver ratio spike. I've actually done it on the futures, and you traded over 128 in terms of how many ounces there. So I've taken the gold future as per the continuous contract and divided it by the silver. So it's exceptional. So we were screaming again. This was a macro rising wedge, which was the financialization of everything. And often in wedges, you get a final blow off. We call that a type 2. So normally wedges, you'll know technically they break down, but sometimes you get a final pop out and they go.
I call them throwovers.
Correct. So our phraseology might be different, but we're surely talking about the same.
That was a hell of a throwover.
Yeah. And it was an opportunity to be seized. And so in there, we said, that is your big boom. Now what's happened, the key level is 70. At the moment, and we are kind of doing a counter trend rally, and that kind of dovetails with the Fed's current positioning. No, we will act on inflation, we'll up rates, we'll wind back the balance sheet. People are buying that to a degree. Generally, I don't think anything meaningful and significant or sustainable. We've been in this position before. So I'm a bluff caller when I listen to central bankers talk on that. They will never settle that balance sheet in my worldview. So overall, you may get a rally, but I want to be short again, the gold silver ratio, which means being aggressively long silver and moderately long gold.
Got it. How will equities fare in this environment? Will they be a good great reset hedge, or is this the time to be thinking about raising cash?
Cash is going to devalue in an inflationary environment. My model is pretty much going inflationary. I also fear if we do have supply chain shortages, there will be black markets. People are going to have to pay more for food and basics and staples. That'll only push inflationary up. And everyone will say, well, it's transitory. It's only because of X, Y, and Z. Right. Ignore the reasons. There's always a reason something goes up. It's inflationary. Is the number up? It's inflationary, not because so-and-so said whatever. So I'm inherently inflationist. So cash long run, being liquid during a deflationary event will give you opportunities to catch the counter trend and get in a better position into silver, get into a better position into various other things. But long run, I want to be invested in unprintable assets that have that would be, you know, precious metals, agris, land, various other elements that you can choose. If you're a crypto guy and you believe Bitcoin is restricted in number, then it can be crypto. Those alternatives. I do not want to be long-term in cash. However, that doesn't mean I'm saying to you right now, don't have cash. Because if we have a super deflationary event, there's a global hack that occurs. Some money gets stolen, lost, written off. You know, Russia, Korea, North Korea is blamed, etc. If you get an event like that, we'd have another event similar to the COVID. So all of those, you need to be liquid to exploit. Everyone would have loved to have bought the silver at $11, I'm imagining, and the equities that are miners in that space. That's your opportunity. So certainly have ammunition dry to exploit, but you want to be committed with the big inflationary trend. Fiat currency is being proliferated. It is not your friend long-term. It's being compounded against you. Position in fixed assets. Your question was about equity, so let me quickly answer it. The key thing about equities, even though by all valuations, they are hopelessly overvalued, you know, PE ratios, all the various different ratios. When you divide it by M2, and I'm going to throw this up super quick for you. This is the amount of money that is being proliferated, the money stock. You will find that actually by historical measures, it's not as extreme as it appears. If you compare it to the dot-com boom, you can see here's where we are. Unfortunately, that means valuations can get more perverted and still relatively be value, because we're comparing it to peanuts. And there are more and more peanuts coming down the chute. And as they diminish, your benchmark is not a true, stable, stake in the ground benchmark. It's fiat currency.
Just going in reverse and to wrap, how do you explain the underperformance of the mainly the gold miners compared to the price of bullion?
It's interesting that you mentioned that equity players are underperforming. I mean, I'm in First Majestic on silver side. I'll also add the oil. I'm long oil, but I mean, Plains all. Yeah, but I'm also long a couple of oil-related equities, and they are underperforming. So I've observed exactly what you've observed, and I think that's because the money is still going into the grand exponential stocks, which are the growth, the data miners, the data farmers, AI. I think technology is a huge sucking vacuum in terms of equity, and it takes a lot of institutional flows. And as they become,
whereas gold miners would be like a garden hose, compressing and doesn't even need, you know, the market cap of all the gold shares out there is probably like IBM.
Yeah, it's very low. It's very low. I think also some people are a bit green fear. You know, the activity of digging a big hole and churning up the earth is not nearly as well received in the new. Who knows what carbon credits are going to be enforced on these types of activities coming. So there's a lot of undefined hazards that haven't been finalized, and in people's minds, they hate uncertainty. So if suddenly all these miners get told they have to buy $1 million a month of carbon taxes to offset the damage they're doing to wherever they're digging, it's quite a thing. While
could it also be a fear of nationalization of mines in unstable areas like in Africa right now?
Absolutely. I don't even think you have to go as far as Africa. It could happen even in the States. You know, America.
That's right.
They've cancelled that you weren't holding. What we have is a massive negative real interest rates. I have a chart. It'll take me too long to find for the time we have left. But if I just describe it, during the 70s, when you had negative real interest rates in terms of your inflation relative to what the bonds were yielding, Americans couldn't own gold. And it was held open, a temporary measure. So your ability to protect yourself as the land of the free was removed from you. And so bear that in mind.
When I started in the business as a runner on the CME is when they made it available to the U.S. citizens again at 200 an ounce. It promptly dropped to 100. And then we had the bull market to 880 with the peaking with Hunt Brothers and the war in Afghanistan, Russia invading another country invading Afghanistan. So, you know, Francis, I'm so glad that I want to thank Hannah for recommending that I talk to you. And you survived this interview with flying colors. Do you know what happens to people that do that?
I'm about to find out.
You become my trading warrior brother.
Oh, I love that. I'm proud
All
to
right.
be there.
So, you're much more than a sniper. I think that you have some cannons to fire too, Francis. I really enjoyed talking to you. It was an excellent, informative interview. All the attendees are making comments about it. And I want to thank you for spending your most valuable currency, which is time, to be with us today.
Oh, absolute pleasure. And thank you for the work you do, doing honest, straightforward, educating and supporting of traders in a sea full of sharks. It's great to have good, straight up graybeards taking people down the straight and narrow. So good one on you.
All right. Thank you, Francis. Have a great weekend. Everyone, that's a wrap. A great way to wrap it with Francis. You could join the team in 10 minutes. And remember, Francis, don't just count your pips, count your blessings. You could always find something to be grateful for.
Indeed.
And that's a wrap, everyone. Hope you had a good week. We laid it all out on the floor, bringing in great people like Francis Hunt. And the best way for people to follow you, Francis, I have your website. It's really nice. And at The Market Sniper on Twitter.
That's it. TheMarketSniper.com and at The Market Sniper for traditional markets on Twitter.
Thank you, buddy.
Also YouTube. Thank
All
you
right.
very much. God
All
bless
right.
you.
All right, everyone. Have a great weekend. We'll see everyone Monday, and the team will see you in a little bit. Adios, everyone.